Well, in the previous 3 chapters, we learned the cost. How does a manufacturing company to accumulate the cost and assign the cost to different products? We learned different ways in previous 3 chapters. But in this chapter, we will go to a more general perspective to look at the behavior of costs. Well, some costs, such as COGS, increase as the volume of the sales increase, but other costs, such as straight line depreciation expense, are not affected by the volume change. So this is the nature or the behaviors of different types of cost. And in this chapter, we will learn a very important managerial tool, that is cost volume profit analysis, or CVP analysis. Well, in this class, I will introduce different cost behaviors, and introduce what is contribution margin and contribution margin ratio. And in the next class, we will learn how to use CVP analysis for managers to do further managerial planning. In addition to CVP analysis, we will learn some other managerial tools based on CVP to calculate some other important ratios, such as margin of safety, operating leverage, and multi-product break-even points. Well, again, as I said, some costs change as the volume of sales increase or decrease, but some other costs are not affected by the changes in volume. So we'll look at 3 different types of costs. They are variable costs, fixed costs, and mixed costs. We will go through each of them one by one. Well, for variable costs are the costs that increase or decrease in total in direct proportion to increase or decrease in volume of activity. Volume is the measure or degree of an activity of a business action that affects costs. The more volume, the more costs incurred. Some activities that are affected by the changing volume, including selling, producing, driving, and calling. The volume of activities can be measured in many different ways, such as numbers of units sold or produced, or number of miles driven by a delivery truck. The direct materials used in the production of tablets computers are variable costs. For example, in Smart Touch Learning Company, each different tablet computer requires a battery, right? If battery costs $55 for each, then the production of each battery increases the total cost incurred by $55. Well, this chart shows the cost for batteries at different levels of activities. If we produce 0 tablets, the total variable cost would be 0. But if we produce 100 tablets, as you see, we will use 100 batteries for each different tablet. And the unit cost for each battery is $55. So as a result, in this case, the total variable cost would be $5,500. As you can see, the total variable cost of batteries increases proportionately as the number of tablets produced increase. But the battery cost per tablet does not change. So this slide shows the total variable cost for batteries as the number of tablets produced increases from 0 to 100. If there are no tablets manufactured at this point, if no tablets are manufactured, the company incurs no battery cost. So the total variable cost begins at the bottom left corner. This point is called the origin, and it represents 0 volume and 0 cost. Well, the slope of this cost line is the change in total battery cost divided by the change in the number of tablets produced. The slope equals the variable cost per unit. Well, in this slide, the slope of the variable cost line is $55 per tablet, because the company would spend $55 on battery for each tablet produced. And it also shows how the total variable cost varies directly with the number of tablets produced. But again, the variable cost per tablet remains constant at $55 per each tablet produced. As shown in the preceding example, direct materials are a variable cost for a manufacturing cost. Direct labor is also a variable cost. Manufacturing overheads, well, usually includes both variable cost and fixed cost. So next, let's look at fixed cost and how it differs from variable cost. Fixed cost. Well, in contrast to variable cost, the fixed cost are are the costs that do not change in total over wide ranges of volume of activities. Some common fixed costs include rent, salaries, property tax, and straight-line depreciation. Smarter learning companies' fixed costs include straight-line depreciation on manufacturing plants and equipment. The company has these fixed costs regardless of the number of tablets produced. Well, suppose the company incurs 13,500 of fixed cost each month, and the number of monthly tablets produced is between 0 and 100. These slides shows the total fixed cost as a flat line that intersects the cost axis at 13,500 because the company will incur the same $13,500 of fixed cost regardless of the number of tablets produced during the period. Well, the total fixed cost do not change as shown in this slide, but the fixed cost per tablet depends on the number of tablets produced. If the company produces 25 tablets, the fixed cost per each tablet would be 540 cents. But if the company produces more tablets, like 100 tablets, the unit fixed cost per each tablet decreases as the number of tablets produced increases. So we can see the total doesn't change. The more you produce, the less per unit fixed cost for each tablet. So here we can conclude that the fixed cost per tablet is inversely related to the number of tablets produced. Or in other words, as the number of tablets increases, the fixed cost per tablet decreases, as you can see in this slide. Well, this is fixed cost and variable cost. And here we have a quick summary of these two types of cost. For the variable cost, the cost per unit remains constant. And in contrast, for the fixed cost, the total fixed cost remains constant. And for variable cost, the total cost changes proportionately to changes in volume. And in contrast, for fixed cost, the cost per unit changes inversely to changes in volume. Well, this is a quick summary. Next, let's see what is a mixed cost. A mixed cost. Well, not all the costs can be classified as either fixed or variable. Those costs that have both variable and fixed components are called mixed cost. For example, a good example is the company's cell phone provider. It charges $100 per month to provide the service, plus an additional 10 cents for each minute of use. Well, if the cell phone is used for 100 minutes during the month, the company will be charged $110. Well, that is calculated as $100 as the base rate plus 100 minutes times 10 cents per minute. Well, that is how this $110 is calculated. Well, this table shows the cost for the cell phone at different levels of activities. I just discussed for the number of minutes used of 100 minutes. And if we use, for example, 500 minutes during the month, the total charge would be $150. Well, that is $100 base rate plus $50 variable cost. Well, the costs like this are called mixed cost that have both variable and fixed components. Well, this slide shows how the company can separate its cell phone bill into fixed and variable components. As you see, the $100 monthly charge is a fixed cost because it's the same no matter how many minutes the company uses the cell phone. The 10 cents per minute charge is a variable cost part. This part increases in direct proportion to the number of minutes of use. Well, this is high-low method, which is a method to separate mixed cost in variable and fixed components. When the companies have mixed cost, it is helpful to separate the cost into their variable and fixed components so that the managers can use the information to make planning and control decisions. Some mixed costs, such as the cell phone cost, are easy to separate, but other costs are not easy to break down. So an easy method to separate the mixed cost into variable and fixed components is called high-low method, shown here. Well, this method requires you to identify the highest and the lowest levels of activity over a period of time. So I'm going to use this example. A summary of smart touch learning companies' manufacturing equipment maintenance cost for each past year shows the following cost for each quarter. Examine the total maintenance cost per quarter. We can see the maintenance costs are not a fixed cost because the total changes each quarter as production changes. We can also determine that this maintenance cost is not a variable cost because the cost per unit changed depending on the number of tablets produced. This must mean that the maintenance cost is a mixed cost. And for a mixed cost has the both fixed and variable components. So now we can use the high-low method, which requires 3 steps to estimate the company's fixed and variable costs of manufacturing equipment maintenance. Well, let's see. The first step. As the name called, high-low method, the first step is to identify the highest and the lowest level of activity and calculate the variable cost per unit. Well, here in this chart, we can see for the highest volume, it incurs at the third quarter. And for the lowest volume, it incurs at the last quarter. So we use the data from third and fourth quarter to do the calculation. So third quarter data and fourth quarter data are identified as the highest and lowest. So we can use this formula to calculate the variable cost per unit, the variable part. We use the cost associated with highest volume minus the cost associated with the lowest volume divided by the highest volume minus the lowest volume? Well, we can see here 1960 minus 1480. Well, these two figures are derived from here. Derived from here. Divided by the highest activity volume minus the lowest activity volume. That is 480 tablets minus 240 tablets. The result is $2 per tablet. So this is the variable part. Well, this is step 1, to identify the highest and the lowest level of activity, and we can get the variable part of the mixed cost. So step 2 is to calculate the total fixed cost. Let's see, how do we do that? We use this formula: total mixed cost minus total variable cost, which is calculated in step 1. This is calculated in step 1. So for a specific quarter, such as the third quarter, we know the total mixed cost is $1,960 minus the variable cost, which is calculated in the first step. So specifically in this example, we have the total fixed cost. This minus the total variable. Sorry. This is the total fixed cost. The total mixed cost. The total mixed cost minus total variable cost. We get total fixed cost, which is $1,000. So in step 1, we know the variable part, and in step 2, we know the fixed part. So in step 3, step 3 is to create and use an equation to show the behavior of a mixed cost. So here it is expressed as this: total mixed cost equals to variable cost per unit, which is $2 per tablet, times the number of units plus total fixed cost, which is $1,000. So this is high-low method. This method provides a rough estimate of fixed and variable costs that can be used for planning purposes. The high and low activity volumes becomes the relevant range, which is discussed in the next section. Managers find the high-low method to be quick and easy, but there are other more complex methods that provide better estimates. One of these methods is regression analysis, which can be completed using spreadsheet software such as Excel. So this method is illustrated in more advanced accounting textbooks. Well, so far, do you have any questions in this calculation? If you have any questions, let me know. No questions? Well, very good. Well, let's go ahead. I just mentioned the relevant range and relativity. Here it is. The relevant range is the range of volume where total costs remain constant and the variable cost per unit remains constant. To estimate costs, managers need to know the relevant range because of the following relationships. First, total cost can differ from one relevant range to another. Secondly, the variable cost per unit can also differ from one relevant range to another. Well, this slide shows fixed cost for smart touch learning over 3 different relevant ranges. If company expects to produce, for example, 2,400 tablets next year, the relevant range is between the second range is between 2001 to 4,000, this range, and the manager will plan for fixed cost of $162,000. Well, to produce more than 4,000 tablets, then it goes to another range, the higher range. The smart touch learning company will have to expand its like the production line. This will increase the total fixed cost for added rents, extra equipment cost, etc. And in this case, if the company produce more than 4,000 tablets, the managers would expect the fixed cost to be $243,000 as the relevant range shifts from lower volume to the higher volume. And conversely, if the company expects to produce less than 2001 tablets, the company will expect only $81,000 of fixed cost. So this is relevant range. Variable cost per unit can also change outside the relevant range. For example, the company may get a quantity discount for batteries if it purchases more than 4,000 batteries. So in this case, if the company gets a volume get discount because of this large volume to be purchased as the raw material, the unit cost would decrease as the total volume increases. So this is the relevant range for variable costs. We also need to remember that costs are classified as fixed or variable relative to some activity. But if the frame of relevance shifts, then the classification can shift too. For example, Smartest Learning may lease cars for sales representatives when making sales calls. The amount of the lease is the same each month. For example, $500. So, relative to the number of tablets produced, the cost is fixed. Increasing or decreasing the number of tablets produced does not change the total amount of the lease. It remains constant at $500 per month. But relative to the number of sales representatives, the cost is variable, as it is directly proportional to the number of sales representatives. If there's one sales representative, the total cost is $500 per month. If there are two sales representatives, then 2 cars would be required. And in this case, the cost doubles to $1,000 per month, while the cost per unit remains the same. This $500 per sales representative. The total cost changes with the change in volume or the number of sales representatives. Okay, the next section. In the next section, we will learn what is operating income using the contribution margin and the contribution margin ratio. Classifying costs as either variable or fixed is referred to as cost behavior because changes in volume can have an effect on how the costs behave. That is, the total cost either changes or remains constant. Let's see how managers can use cost behavior to make decisions. Contribution margin. So what is contribution margin and how it can be used to compute the operating income? Well, contribution margin is actually the difference between net sales and variable costs. Well, it is called contribution margin because it is the amount that contributes to covering the fixed cost and then to providing operating income. Contribution margin is often expressed in total. Well, for example, in the previous example, we know the total sales volume is 200 tablets, and the selling price is $500 per tablet. For each tablet manufactured, the cost is $275. So the contribution margin, as I said, is the difference between net sales revenue and variable cost. So in this case, we know the net sales revenue is $500 times 200 tablets sold minus $275 times 200 tablets sold. We get the contribution margin to be $45,000 in this case. Well, this is the first expression of contribution margin. The contribution margin is often expressed as a unit amount. So it means for each tablet sold, how much it can contribute to the total contribution margin. For this calculation, we use this formula. The unit contribution margin equals to net sales revenue per unit minus variable cost per unit. Well, it is pretty much straightforward if you compare this formula to the previous one. In the previous example, we use the selling price times the number of units sold, and minus the variable cost times the number of units sold. So in the second example, in the second way to express the contribution margin, we do not divide the number of tablets sold. We use 500, which is the selling price, directly minus the variable cost per each unit, which is $200.75. Or in other words, unit contribution margin is the total contribution margin divided by 200. That is $225 per tablet. Well, a third way to express contribution margin is as a ratio. It is called contribution margin ratio. It is the ratio of contribution margin to net sales revenue. Because contribution margin is based on sales price and variables, which do not change per unit. The ratio can be calculated using either the total amounts or the unit amounts. Well, certainly for total amounts, this is the formula, and for the unit amounts, you use the second formula. But no matter which formula you use, you get the same exactly the same result, which is 45%. You can use total contribution margin divided by total net sales revenue. You get 45% as the contribution margin ratio, or the unit contribution margin divided by net sales revenue per unit. You get the same thing, 45% as the contribution margin ratio. Well, now let's see a contribution margin income statement. The traditional income statement classifies the cost by function. That is, the costs are classified as either product cost or period cost. Remember that product costs are those costs that are incurred in the purchase or production of the product sold. For a manufacturing company, the product costs are direct materials, direct labor, and manufacturing overhead. These costs accumulate in inventory accounts until the product is sold. At that point, the costs are transferred to the expense accounts, that is COGS account. The period costs are the selling and administrative costs. This is the format that is required by GAAP, GAAP, the generally accepted accounting principles. Well, this format, I believe, is the format that you're familiar in your financial accounting class. The traditional income statement format doesn't always provide enough information for managers. So another format which is introduced here, contribution margin income statement, is used, especially for internal managers, to better assist them to make managerial decisions. A contribution margin income statement classifies the cost by behaviors. That is, the costs are classified as either variable cost or fixed cost. The contribution margin income statement also highlights the contribution margin rather than the gross profits. Well, why it is more important for internal managers to make decisions for a company? We will learn this in the future chapters. So that is all of today's class. I can understand that there are a lot of calculation, not only in today's class, but also in the next class. In the next class, we will learn the CVP analysis, how to use CVP analysis to find the break-even point. Well, I hope you guys can have a good review of what is learned. And in the next class, we will learn how to use CVP analysis. All right, so if you have any other questions, please let me know. Or I will see you in the next class on Wednesday. All right. See you guys.